Effective supply chain management gives power to fulfill what your customers need, when and where they need it. How will you ensure that your supply chain is reliable, flexible, innovative, and always strives for excellence?
Since the past 2 decades, TVS SCS has been the trusted name in the supply chain industry.
The legacy of TVS brand is more than 100 years old.
We are trusted for the value that we have created.
Our global presence with unmatched supply chain network pan-India, warehousing space of more than 19 million square feet, transportation network across 29 states, and a strong team of more than 10,000 professionals stand together to serve our esteemed customers.
We are trusted for the service that we provide.
Our end-to-end differentiated service portfolio is fitted as per customers' demands. We are partners in customers' journey.
We are trusted for the innovation that we can offer.
Strong technology backbone, integrated digital workflows, automated dashboards, visibility through control tower operation. We are just the way you want us, equipped with all the tools to make your supply chain resilient and agile.
We believe in the power of us.
When we partner with you, we are committed to offer you quality solutions. Together, we strive to achieve newer heights. Together, we stand united to write new success stories.
Hello. Hello, can you hear me?
Good morning, Professor Goel. Good morning.
Good morning.
Good morning. I mean, are you?
You are on mute. I can't hear you. You're on mute. You're on mute. I can't hear you.
Just 1 second. Is it clear now?
Yes, yes.
Oh,
You can hear me, right?
yes, we can hear you. You're clear. You're loud and clear, ma'am.
Okay, good.
Thank you. Thank you. We'll start the session momentarily, and I'll just get the other panelists also onto the stage.
Right, right.
Thank you.
Good morning, ladies and gentlemen. May I request you all to be please seated. We are shortly going to start with the session on rates and recession, how to insulate the world from shocks. Good morning, ladies and gentlemen. I welcome you all to the session on rates and recession, how to insulate the world from shocks. To begin with, may I now request our session moderator, Dr. Janmejay Sinha, Chairman, BCG India, to take the session forward. Thank you.
Good morning. It's my great pleasure to be here with a panel which really covers the world well, because we have Luis here, who is with the IMF, and he will tell us all that the IMF wants us to do. We have Tom, who is really fascinating, because not just is he working with Bloomberg, but also he has spent 11 years in China, and now he is in Washington. So he will, really look at all the economics through the geopolitical lens that you can imagine. And then we have Professor Ashima Goel, who's in Bombay, because she's going to tell us what RBI will do with rates, as she is thinking about what she'll say in the MPC. So we'll have her, we will challenge her as to why RBI is doing the kinds of things that it is. And so we'll have some fun in this session, I will be as provocative as I normally am, and I don't really have to, I can ask the questions, they can answer the way they want. So just to set it up, if you really look at the world today, if you take the US, it's about $22 trillion as an economy. Then you go to Europe, it's 17 trillion now that UK is not in it. If you add UK to it, it's also about $20 trillion. China is about $17 trillion. Japan is 5 trillion, and India is 3.5 trillion. These 5 blocks, so to speak, are 65% of the global economy. And just think of what's happening. In the US, in this $22 trillion economy, $5 trillion of stimulus was thrown in. That means almost 2 Indias. So the Fed is doing what any reasonable central bank would do, right? It's raising rates because you have created so much stimulus that you want to control inflation. But there have been some things which are a hangover of COVID and the earlier policies of the administration around migration. And with so much money in, some people have retired early. So the labor force has reduced. And so despite the fact that interest rates have been raised by 500 basis points, you still have a very tight labor market. And now with the raise in with interest rates rising, we can now even start seeing the secondary impact, where your treasury portfolios start to become loss-making if you can't hold them to maturity, as you noticed with Silicon Valley Bank. So that's the US. Then you have Europe, which is a very interesting case. It has imported inflation because of the Russian invasion into Ukraine. And so suddenly commodity prices have gone, energy prices have gone up, and they've had to deal with it. And of course, we've all been waiting for the Europe to go into recession. It hasn't yet gone into recession, but that's the discussion there. And interest rate rises may not really quell inflation there because they are importing the inflation in form of energy prices. China is a different deal altogether. China closed down its economy and then it suddenly opened its economy. And now it's going through some of the trauma of post-COVID, once you just open the economy. But in the second half, for all you know, you'll see a much stronger Chinese economy, which will put further pressure on energy prices, so what will happen there? And then in this 65%, when you look at countries like India and other countries in the South, we are all facing the impact of the Fed rate rises. And, what does that make us do to manage our currency, to manage inflation, which some of it is coming through imports of energy prices. But the geopolitics in India, strangely, has moderated the impact of energy prices on us because we have managed to get Russian oil. So in that sense, some of the worst impact of energy has been moderated from us. Japan, of course, has played a different game altogether, and you see the Japanese currency has fallen, 20-30% during this period. So in this construct, I am going to actually go through this discussion where I'm going to come to Professor Goel last, because she's going to then tell us what's happening with MPC and how that will happen. But first, let me begin with you, Louis. In this construct, how does the IMF see the appropriate way forward with rate rises?
Thank you very much, Dr. Sinha, and thanks CII for the kind invitation. I'd like to respond to that question by talking about 3 things. How we see the global context, growth specifically, how we see inflation at the global stage and regional stage, and interest rates, and how can India react to that changing landscape. And basically, what we see is that the global economy is at a turning point. We estimate that growth last year, calendar year, was about 3.4% at the global level, and that it will reach 2.9% this year, so slow down, and accelerate modestly next year to 3.1%. We have seen three broad forces that have been impacting the world economy since last year, since 2022. The war in Ukraine, with the impact on commodity prices, energy, food, as well as the economies in Europe. Now, commodity prices have fallen from their peaks. They remain elevated. So the impact of the war in Ukraine on the global economy has slowed down quite a bit compared to a few months ago. The second big force is the reopening of China that Dr. Sinha mentioned. And this is happening much faster than anybody anticipated. And it is leading to a very rapid rebound of the economy. Now, the driver of that rebound is domestic consumption, which means that external demand for countries that trade with China has so far been muted. It's still early in the process, but we haven't seen a big increase in Chinese imports, whether commodities or any other products. It's mostly consumption driven. And we expect Chinese growth to be significantly higher this year to what it was last year. And the third big force is, of course, the global fight against inflation. During much of last year and early this year, many countries around the globe were tightening monetary policies. And in late last year, there was some good news in the sense that some broad measures of inflation, like consumer price indices, were starting to peak and even fall down in a number of countries. Unfortunately, that expectation has not really materialized this year, when we've seen that core inflation, a narrower measure of inflation, where you usually take out the very volatile prices that tend to be energy, food, and so forth, core inflation has remained persistently high in the US, in Europe, in India, in a number of Asian countries. Now, the big picture is that we do see the global economy at a turning point, and that inflation may fall around the globe. And the tightening of monetary policy that happened in previous months, we expect to start to work on economic activity and inflation. So we should expect results on the inflation front. On the medium term, we're not so optimistic about global growth, certainly not returning to the pre-pandemic growth rates, because there are concerns about productivity growth in many countries, including in China. There are concerns about demographics and aging. There are concerns about scarring from the pandemic and from the war in Ukraine. Our most likely scenario is one of slow and picking up growth. But we also see some important downside risks. The main one today being the repricing of risk and financial sector volatility. You have all read about the problems with SVB in the US, and that, in a sense, is related to the path of monetary policy in the US. We also see a risk of more persistent inflation that may require even higher interest rates, leading to even more tension between the fight against inflation and financial stability. But we also do see some upside risk. As Dr. Sinha has mentioned, one of the bright spots in the global economy is the strength of labor markets in advanced economies, including the US, which might signal that growth will be higher than expected, although this might create some challenges on the inflation front. On inflation, I mentioned that it fell late last year, but has remained persistent in the course of this year. And this may require further tightening of monetary policy, higher interest rates, which are still historically at levels that are not very high, given the period of very, very lax monetary policy in advanced countries and many emerging countries after the global financial crisis and after the pandemic set in. Now, recent IMF research has shown that U.S. monetary policy has spillovers on other countries in Asia, on emerging markets, including in India. Higher U.S. interest rates suck capital from the world, lead to tighter financial conditions across the world, and higher interest rates elsewhere, too. Now, excuse me, higher interest rates, as you know, will, through a number of channels of transmission, affect the economy, through lower private investment, through lower external demand, through higher debt service burdens to the extent that debt is denominated in foreign currency. Now, India remains a bright spot in the global economy. It's growing at a very robust level. We estimate growth at 6.8% for this fiscal year that ends at the end of the month. We project growth of 6.1% for the next fiscal year, more than twice the global growth. But beyond the numbers, balance sheets of corporates and banks have improved, bank credit has returned, inflation has stabilized. India has a lot of good things going for itself. You've been through a process of a number of reforms that we expect to lead to higher productivity gains, higher potential growth. But of course, India is integrated to the rest of the world and will be affected by what happens in other countries. So how do we see the policy reaction that would be appropriate to face this changing international landscape? One, on fiscal policy. The government has announced a very prudent budget and a fiscal consolidation path to reduce and stabilize public debt, which is quite high in India compared to other, say, G20 countries. We think that's a very good thing. And in fact, we think that a clearly spelled out medium-term fiscal plan that has ambitious fiscal targets and a description of the policies to be followed to reach those targets can serve the country very well. On monetary policy, we think that the RBI is doing the right thing. We believe that the tightening stance is the appropriate stance for India in the medium term to promote sustainable, stable growth over many years and not just focus on the next 3 months. And there might be need to further increase rates if inflation does not turn the corner. And as you know, core inflation has been very sticky in India, surprisingly sticky, despite the multiple shocks that the economy went through. On exchange rate policy, we believe that exchange rate flexibility is the best way to manage and to face this very shock-prone world that we live in today, and to use exchange rate interventions very tactically to avoid disorderly market conditions that could lead to confidence problems. And on structural policies, India has been pursuing a number of reforms, including during COVID, and we believe that these reforms should continue because they are the ones that can counterbalance these headwinds that are coming from the international economy and make the economy's ability to grow faster in a stable situation. What are some of the priorities that we see? Trade reforms, education, continued digitalization, which is an incredible achievement that India has done and has generated a lot of interest, including during the G20 meetings from the rest of the world, product and labor reforms, and facilitating a transition to a green economy. Overall, India is facing challenges, most of which come from the international economy, but we feel that the country is in a strong economic position and is very well poised to face these challenges. Thank you.
Thank you, Louis. I'll come back to you with a few questions later, but first let me go to you, Tom.
Thanks very much, Dr. Sina. Great to be back in Delhi, and thanks so much to the Confederation of Indian Industry for putting on this amazing event and inviting me to participate. So, since the fall of the Berlin Wall, rising global prosperity has been underpinned by three pillars: low global borrowing costs, supercharged demand from China, and limited geopolitical frictions. I want to make the case today that in the last couple of years, all of those pillars of prosperity have been kicked away. Inflation, the beast which we thought Paul Volcker had slain back in the 1980s, is back, and that's forced the Federal Reserve and other major central banks onto the most aggressive tightening trajectory that we've seen in the last 4 decades. And that shift from a world of cheap money to a world of expensive money means a wrenching dislocation for the global economy and financial system. In a world of cheap money, Silicon Valley Bank looks like a great place for tech entrepreneurs to put their deposits. In a world of expensive money, Silicon Valley Bank and many of the tech entrepreneurs that put their money there are unfortunately bankrupt. In a world of cheap money, Mark Zuckerberg is building the metaverse, whatever that is. In a world of expensive money, Mark Zuckerberg is saying goodbye to thousands of his employees. In a world of cheap money, India's neighbors, Pakistan and Sri Lanka, can borrow what they need to pay for essential imports. In a world of expensive money, they can't. Put simply, in a world of cheap money, everything is easy. In a world of expensive money, everything is difficult, and we are now in a world of expensive money. On China, much of the latest news has actually been rather positive. The end of COVID lockdowns, more support for the property sector, more support for entrepreneurs. All of these are good news for growth, and we expect a strong rebound in the Chinese economy this year. Looking further forward, though, China faces some very significant structural challenges. Demographics, debt, overcapacity in industry, overcapacity in real estate. All of these are going to drag on growth in the years ahead. It wasn't so long ago that the Chinese economy could be counted on to reliably deliver annual growth of 8, 9, 10% a year. This year, we expect China's growth to be a little over 5%, and in the years ahead, even 5% is going to be a challenge to sustain. And for the rest of the world, that shift from a Chinese economy growing 10% a year to a Chinese economy growing perhaps 4% a year is also a wrenching dislocation. Why have the economies of ASEAN, Singapore, the Philippines, Malaysia, Thailand, Indonesia, done so well in recent years? Well, the most important reason is the intelligence and ingenuity of the people there, but an additional important driver has been Chinese demand. When China's GDP accelerates 1 percentage point, that adds about 0.5 percentage points to growth in the smaller ASEAN economies. As China now decelerates, that driver is going to turn into a drag. Commodity exporters like Brazil and Chile, which have dug and mined to produce the raw materials which feed China's industrial engine, also face a significant challenge as China's growth slows. On geopolitics, in 1989, looking forward to the collapse of the Soviet Union, the political scientist Francis Fukuyama declared the end of history with the final triumph of free markets and democracy. With the benefit of more than 3 decades of hindsight, I think we can now say that Fukuyama's end of history claim was a little bit premature. The rise of China means that the share of global GDP coming from the free market democratic West is now in structural decline. Far from living in an end-of-history unipolar world, we find ourselves in a world where history is back, power is distributed between multiple different poles, and rival political and economic systems are jostling for influence. And that return of history also has profound consequences for the global economy. In a world where history is over, Europe can rely on Russia for its supplies of energy. In a world where history is back, they can't. In a world where history is over, the whole world can count on a small island off the coast of mainland China for their supplies of semiconductors. In a world where history is back, that looks like a very, very risky dependency. In a world where history is over, cross-border trade and capital flows mean that goods are cheap, energy is abundant, inflation is low, and growth is robust. In a world where history is back, barriers to trade between major economies mean supply chains are snarled, energy is scarce, inflation is volatile, and growth is always vulnerable. To avoid leaving you with too gloomy an impression, let me note that there are some very, very important parts of the world, especially India, where growth prospects are actually rather robust. I entirely agree with Louis that the combination of demographics with a rising working age population, smart reforms by the Modi administration, and geopolitical tailwinds as the US and its allies look for China +1 strategies are all positives for India, which mean strong growth prospects not just in 2023, but for many years ahead. But for the world economy writ large, the collapse of those 3 pillars of prosperity, low rates, supercharged demand from China, and limited geopolitical stress, is a serious problem, and a problem which I don't think is going to go away anytime soon.
Thanks, Tom. Could I come to you, Dr. Goel? Can you hear me?
Yes.
Okay. Could I ask you to make some comments now?
Thank you, Dr. Sinha. Thanks, CII. You know, you promised to be controversial, but I don't think you've been controversial enough. So I will try to do that. Yeah.
Wonderful.
So I want to start by talking about India, then I'll talk about the rest of the world. So as the other speakers have noted, India is one of the countries that has done relatively well in this period. But apart from the changes in the globe and so on, which are responsible, it's also to be noted that you've done particularly well in a period of what I call large, continuous, shocks from the external, from the rest of the world. And I want to highlight 4 principles which I think are responsible for India managing these shocks relatively well. So I just call them BCCR. The first is balance. You know, balance means, just as examples, balance between supply side and demand, stimulating policies during the pandemic, balance between inflation and growth by the MPC of the Reserve Bank, balance in the sense of not overreacting to any one situation, which is good for financial stability, reforms that also improved financial stability. Most important to avoid overreaction. So balance. Then the third is counter-cyclical. In India, traditionally, monetary macro policy with a little push from the IMF has been focused on reforms, on structural changes, such as introducing inflation targeting and so on. And we have never been counter-cyclical. But I think during these shocks, there has been a counter-cyclical stance, which has been very important to smooth these shocks. Then the third is coordination. The second C stands for coordination. So there is coordination between monetary and fiscal policy. Earlier, the stance was, was that you need monetary policy to be independent of fiscal. But when supply side shocks dominate, and this has always been the case in India, though the rest of the world has started noticing supply shocks now. But when supply shocks dominate, the fiscal action can have more effect on this, whether it's short-run excise changes or longer-run removal of bottlenecks, etc. So in this period of supply shock-led inflation due to global supply bottlenecks, sharp rise in oil shocks, fiscal action helped moderate inflation and therefore reduced the amount of extra tightening or action that the MPC had to do. And the R, the BCCR, R stands for reforms. So smart reforms that have ridden on current trends, not like the land labor reforms that the IMF and other institutions try to flag for India, but those create political resistance and have political costs. But smart reforms that work on current trends, such as new technology, youth, the potential in digitalization, etc. So when I say that India has followed this approach, which seems to have worked better, I'd say now we come to the rest of the world. Advanced economies went in for overstimulus during the pandemic. You know, the big guns approach, disaster, do whatever you can, shoot everything possible, you know, and so there was overstimulus, huge fiscal stimulus. And then as a response, when inflation went up and fiscal stimulus, demand stimulus at a time when the global supply bottlenecks was not appropriate. And so obviously it led to over tightening. So I would like to flag that it's not the whole world that is fighting inflation. It started with advanced economies that had done over stimulus, over to increase demand too much. And this had spillovers for the rest of the world. As Lewis remarked, monetary policy in the US, other policies, that is the dominant economy. So what they do affects the rest of the world. There are spillovers to the rest of the world. And I would like to remind Lewis, the IMF is responsible for maintaining global financial stability. So their job is to give technical advice, not only to emerging markets, but also to the US. And at present, again, I think there is an urgent need to reduce overreaction because we have seen what happened to SVB. Rates had to rise because they had been cut exceptionally low during the pandemic. But when they reach a certain level, you have to go very slowly. You cannot announce that we are going to keep them high for longer. We're going to keep them high independently of data. We're going to keep them high no matter what. You cannot announce that inflation is going to be persistent when we know that it is driven by supply side changes and geopolitical, etc., makes the supply side very volatile. So it is good to have a data-based and a moderate policy. As Lewis said, after large interest rate rises, you know that there are lags with which they act. It takes 2 to 3 quarters before interest rate rise starts affecting demand and therefore demand-led inflation. So it's appropriate to watch for some time, allow these to affect before just continue. You cannot just keep raising rates until inflation starts falling. That is a recipe for overreaction, over-tightening, and creating financial instability. So there are also when you are overreacting, say, on interest rate policy, there is macroprudential regulation. Now, this is underutilized by the advanced economies. I don't have time to go into it. But for example, SVB. Now, if you had macroprudential regulation, you would have exposure limits. Prevent a bank like SVB putting all its money into treasuries where you have capital losses. So in India, we have this kind of regulation for non-bank financial intermediaries. In the advanced economies, regulation concentrated too much on banks, but not on these broader kind of reducing risky behavior. So that is also required. It's very important. And then, so overall in India, I think what helps is diversity. You have a number of areas when one area is not doing well. For example, if manufacturing is a lockdown, agriculture does better. So encourage diversity. And this is part of avoiding overreaction and extreme. You have different parts moving, encourage the different parts. Now, finally, I'll just say a few things. This year, apart from being on the MPC, I'm also chairing the Task Force 5 of India's T20, which is concerned with fitting the Bretton Woods institutions to purpose. They have not done as much as they could, given the kind of problems we have internationally. And especially now, we need to be forward-looking. We know about the urgency of climate change and the necessity of really raising resources for this. And what has been raised so far is extremely inadequate. So in the Task Force 5, we are focusing on three things. One is increasing the quantity of finance for the world and especially for the poorer nations, and reducing its cost, because although, as Tom said, now you are going into a higher interest rate globe, but the cost of borrowing is especially high for emerging markets because they have very large spreads on whatever the risk-free rate is. And these spreads can reduce, and they can reduce if international institutions do more work on providing information on emerging markets, using better measurement, the digital tools available, standardization, etc., which would all reduce lender uncertainty and provide more warranties to help private sector participation. Also, much more coordination with regional and national MDBs, which could increase the amount of finance available many times. Then the third thing is the cost, quantity. And so to reduce cost, also reducing the volatility in emerging market asset prices. Again, as Louis said, spillovers from monetary policy elsewhere, spillovers from the lack of regulation of NBFIs, which leads to very large volatility in capital flows. So we are told to use our exchange rate as a buffer, but there's very often overshooting of exchange rates. And when this is due to global risk on and risk off, when we have done all that we can to reduce risks, macro risks, etc., most emerging markets after the East Asian crisis have improved their systems. So obviously the global, you need to do more to reduce this volatility, and much is possible through international pooling of risk, making swap lines available. There's much more, again, the international institutions, given their responsibility, have not done enough to reduce spillovers on emerging markets. So cost, quantity, and then implementation. Many of these ideas have been there for a very long time, but their implementation is very poor. So how is it that more can happen? Because we can't afford to just keep talking when climate change, we've already seen huge effects on countries throughout the world, not just emerging markets. In France, in the US, in Australia, we've seen huge impacts of climate change. So it is critical, absolutely urgent. And we are seeing enough of a global push developing to do something on this. So again, in the TFI, we're going to examine whether some procedural incentive changes can make a difference, or it has to be board-led. So what are the changes that can improve implementation? And all these are factors that would reduce global shocks and make the world more resilient against the shocks that will keep coming. But we have to be prepared for it. Yeah, thank you.
Great. So now what I'm going to do, I'm going to ask each of you a question, and then I'll open it to the audience, and then come back to you all for some final comments, and then go sum up, if it is possible. So the first question for you, Louis, is Oscar Wilde had once said, "The art of prophecy is very difficult, especially about the future." And I find that economists tend to prove that all the time. We were expecting that Russia would be minus 13, 14% GDP. And it's actually done reasonably well. And UK is actually doing very badly. We were expecting Europe to be in recession every quarter for the last 2 quarters, but it hasn't gone into recession. And we were expecting that China will take time to stabilize before it starts coming back up, as an economy. What is it that we track that allows us to miss such big trends?
If your question relates to projections, I think that I could say a few things about that. Number one, we live in an incredibly uncertain world, very prone to shocks. And between 2000 and 2008, the economy of the world was expanding, between 2002, I would say, very rapidly. Inflation was not an issue. China was pulling commodity exporters out of poverty, and things look really good. But since 2008, we've had one series of shock after another, big shocks, once in a century or in half a century shocks. The global financial crisis, the pandemic, the war in Ukraine, the impact on commodities. So these are obviously things that have not been anticipated, which change the economic trajectory of the world, of countries, etc. In addition, in the case of Russia and the UK, the contraction was not as large as expected, but these are not economies that are doing well. For example, just looking at the latest IMF projections that came out in January, and they will be revised next month in April, but the IMF projects the UK economy to be in recession this year, minus 0.6%, and only recover very slowly, less than 1% next year. Again, Russia had a very sharp deceleration, contracted by 2.2% in 2022, and will basically not grow this year. So it's not that these countries are doing well, but the extent of the recession was not what was projected earlier. And in part, it has to do with the fact that these economies proved to be more resilient than expected. And these shocks led to policy reactions and adaptations that mitigated some of the adverse impact. But it is true that now projecting anything beyond 6 months is really an exercise in wishful thinking, because the economy is changing very quickly. Take the example of the opening of China. They went from a very closed economy to virtually opening everything overnight. And nobody really expected that. And of course, that's going to be reflected in projections needing to be updated.
Thank you. To Tom, the question I have for you is around China. You were there for so many years. You were there between 2007 and 18. You saw the end of Hu Jintao. You saw how Xi Jinping got into power and then consolidated. The one thing that has always surprised me a little is that while monetary policy in every other country, we talk about the trinity of exchange rate, interest rates, and money supply, how does China keep a static exchange rate. Its interest rates, seem to not be correlated in the same way to the global markets. How does that economy work? What happens out there?
Great question. If I may, just one reflection on your earlier question to Louis. I'm reminded of a comment which the great British economist John Maynard Keynes made in the depth of the Great Depression. He said, "We have lost control of a machine whose operations we little understand." And I think 100 years on, there's been a lot of advances in economics, but I completely agree with Louis that in the last decade, the shocks which have hit the global economy and the struggles of the economics profession to understand the impact of those shocks and the impact on the outlook has been a humbling experience in terms of how much we can do to understand this complex machine and how accurately we can forecast. So to your question on China, I think one important thing to keep in mind about the Chinese economy and a sharp contrast between the Chinese economy and the US economy and the Indian economy is the role of the state in the Chinese economy and the philosophy of the people who run that state-dominated machine. So in the United States, in Europe, in India, there is a general belief that market forces and the private sector should be the dominant forces governing how the economy works, and that intervention in the economy by the state, by the fiscal authorities, by the central bank should be kept to an absolute minimum to allow the market forces to play that dynamic force in driving growth. In China, they do not share that philosophy. There is, of course, a recognition that the private sector is valuable, can be a driver of dynamism, can boost productivity, but at the same time, there is also a belief in the power of the state, a belief in the power of the state as an agent in the economy through the state-owned banks and the state-owned enterprises, and a belief that policymakers can be kind of engineers of prosperity. Chinese policymakers don't share the kind of invisible hand view of Adam Smith that the market should be left to its own devices. They want to get their hands on the different moving parts of the economic machine. Now, in the bad times, that means that China's policymakers have an unusual array of levers they can use to keep the economy going. They can turn cross-border capital flows on or off. They can instruct state banks to ramp up lending or reduce lending. They can instruct state enterprises to boost investment and employment or pull back on investment if the economy is overheating. And all of those things mean that China's been able to deliver remarkable decades of steady growth and increasing prosperity. At the same time, diminishing the role of the private sector in the economy does mean a cost in terms of dynamism, a cost in terms of productivity growth. And I think in the years ahead, as China's growth slows, we're going to see the costs of that limited private sector role.
It will be interesting to debate that more. We don't have time, but I'm going to come to you, Dr. Goyal, and ask you a question, which has always puzzled me, and you sit on the MPC. Between 2015, up to 2015, that's about 65, 70 years, India had an inflation of around 7% on average over this long period of time. And then suddenly we created a monetary policy committee with a target of 4%. Why did we choose 4% as an interest rate target and not 5%? And, when you compare that to, say, South Korea during 1980 and 95, it had 6, 7, 8% inflation during those years. Why have we chosen such a stringent inflation target? Is there any thought of revising it upwards?
Well, RBI or the MPC is only the agent of the government, and the government is the agent of the people of India. So this is a target which is given by the government to the MPC. And when the inflation targeting regime was introduced, I was not involved in the debating that went on, so which decided that it's going to be 4%. But I can flag a number of reasons why. One is that if our inflation rate, that time the world rate of inflation was much lower. So if our inflation rate is higher, that means constant depreciation and inflation pressures that exist. So in an open economy, you want your inflation to be closer to world inflation rate. That is one. The other is that if you're looking at myself done estimations of the Phillips curve of the expected inflation or core inflation. And this was some years back, and that time you're right, the core inflation came out to be 5%. Yeah. But when you introduce a inflation targeting process, and I've written that in an emerging market where information given by the government or the regulatory agency has a lot of weight because there's less other information available. You can guide expectations, the rent, wage setting, the interest rate spreads in markets so that your inflation comes out closer to 4% over time. So I think these were the reasons that, but now as many people have flagged, if you're moving towards higher inflation rates in the rest of the world because the China factor that was keeping inflation low is moderating, then maybe we need to rethink our long-term inflation target. Or it could be that the gap between India and the rest of the world will go. The rest of the world will also have inflation of 4%, and we are fine with 4%. So this is an area where we could see some changes as we learn what's happening.
Okay, that's helpful. I'm going to take 3 questions from the audience. Whoever is, yes, sir. He's just behind you.
Thank you very much for excellent talk. I have 2 questions, a question for Lewis and a question for Tom. Can U.S. pay his commitment? Question for Lewis. With his debt? That's the question. Can United States pay his debt? That's the question for you, if you don't mind. And a question for Tom is, what about credit card situation in the United States? We've been hearing many times a lot of things about credit card crunch, similar to what happened back in 2007. So what are those 2 risks that I'd like to know from you as expert?
I'll collect the other questions and then we can answer. Yes, sir.
Hi, my name is Abhishek Gupta. I'm the India economist at Bloomberg. In my recent research, I find that it's going to take a little bit of time.
No, can you make it brief? We don't have time right now. I'm sorry. We just don't have time.
Sounds good.
It'll have to be a question.
Sure. The question is that India's inflation, which has jumped very sharply from 5.7% in December to 6.5% in January and in February, the underlying reason for this jump suggests that there could have been shifts in the statistical weights because of government's decision to reduce the price of subsidized rice from a positive number to 0 number, and how the IMF guidelines might have led the statistical agency to interpret that number. And to an extent, if this jump in inflation might be driving the RBI to hike rates further, that might be in policy error. So probably the question is to Ashima Goel. In her view, has the RBI or has the MPC looked at this, this factor of inflation being statistical in nature? Yeah, I'll just go there.
One more question. Yes, ma'am. You're at the back.
Good morning. My name is Gitanjali, and I'm from the International Trade Policy Division of the CII. I have a question for Professor Goel. I just want to know, it's because of the developed countries that we are following a tight monetary policy. Just because they do, we are more or less to do, because then this affects our aggregate demand as well as growth revival. And also the fact that they have a tight monetary policy, there's a lot of capital outflows going from India. And the dollar is also appreciating, which makes it difficult for poor countries, to repay their debt, which is a dollar-denominated debt. So what is the G20 doing in this kind of a scenario? What is the coordinated approach that G20 can have? It's basically some kind of an imported inflation, because the critical capital that is needed for your production is also not coming through because of the tight monetary policy.
Fine.
Thank you.
So let me, Louis.
Very quickly on the U.S. debt, it's a very important instrument that is a foundational instrument in the international monetary system. Many central banks invest in U.S. government securities, many corporates, etc. So your question is a very important one. Now, the U.S. does not need to pay off its debt overnight. It rolls over most of it. In fact, it's been increasing in recent years. But we don't see any problems with that continuing in the foreseeable future.
So let me briefly take on the US pay its debt question and the credit crunch question. So can the US pay its debt, or as Louis say, roll over its debt? Absolutely. Will it choose to do that? That's the question. And that isn't an economic and financial question, it's really a political question. And the question of whether the US will breach the debt ceiling and trigger that potential cataclysm in global financial markets by defaulting on its debt obligations really comes down to a debate between the Republicans and the Democrats in the US Congress. The early signs are that perhaps they might be able to bridge their differences and avoid hitting that debt ceiling. Let's hope that that's how things play out. Certainly the world doesn't need any more shocks to deal with. And then on the credit crunch question, I guess what you're referring to is what's happening with Silicon Valley Bank. So there are some broad stresses in the US banking system as a result of the rapid increase in interest rates. And I'm sure that there are a number of banks which are sitting on unrealized losses on their holdings of US Treasuries as a consequence of that sharp increase in interest rates. At the same time, Silicon Valley Bank has some unique problems. Silicon Valley Bank was the bank for the Silicon Valley tech entrepreneurs, and what that means is that Silicon Valley Bank's liabilities, their deposits, are unusually large and unusually concentrated. And what that means is that Silicon Valley Bank was unusually vulnerable. So clearly this is a risky moment. Clearly it's a rapidly evolving situation, and we'll have to see how things play out in the days and weeks ahead. Our initial view, though, is that because of the peculiar characteristic of Silicon Valley Bank and its concentrated liability base, its concentrated deposit base, and because of the rapid actions by the Fed and the FDIC and the US Treasury, this is not likely to spill over into broader contagion, not likely to spill over into a Lehman-style credit crunch.
Okay, Dr. Goel, now I'm coming to you. There were two questions.
Right.
One was, and I'm going to add a third one, which is, I hope RBI will pause its rate rises. I hope you see it that way too. So those are the three questions for you.
Yeah, thank you. I just wanted to say briefly about the US debt. The problem today is that interest rates are going up, and very high debt, it becomes a problem and the share of interest payments rise. So they need to reduce their debt. Yeah. And second, Abhishek, yeah, this is again our statistical artifact. I agree that we have a very large share of food in the CPI headline, which is our target. And these weights are based in 2012. A lot of change since then. They need to be revised. This is part of the supply side. This is what the government should do, and there is discussion ongoing with them. So let's hope, because what the RBI does in rate rises only affect demand side inflation. For Gitanjali, right, it is true that there is a pass-through of tightening in the Fed, in the US especially, to countries around the globe. But there are degrees of freedom depending on your domestic cycle. To the extent we are facing higher inflation because of oil and food shocks, we need to be careful not to overheat or take supply side policies. And we can use the exchange rate, we can use capital flow management, we can use foreign exchange intervention to reduce the passover. It's not, if you don't have full, you have some degrees of freedom which you can use. And as I said, past episode, Indian macro policy has used those degrees of freedom so as not to follow the US tightening to the full extent. Also, we started from a much higher level. They were at 0, we were at 4. And we do not have excess demand-led inflation. So there's much less tightening that we need. Then finally, these are my views as one member of the MPC. So whether the MPC and the RBI will pause or not. But as you know, I had my vote was for a pause even last time. So I hope that that logic and that argument will be appreciated.
We salute you on that. It's that time when we bring this session to a close. I must say that I learned a lot during the session, and I just want to highlight a few of the issues that were brought up, which just are useful to keep in mind as we look at what's unfolding. Louis brought out that there are 3 things that one should keep looking at. One is how the war in Ukraine progresses, how China reopens, and how fast and how quickly it stabilizes, and how the fight against inflation globally pans out. So he brought those out, and then he gave us a good perspective on how to actually evaluate that more deeply. Tom brought out, again, the fact of cost of capital becoming more expensive and China demand coming in, and introduced very importantly how geopolitics is now starting to influence the global economy, in all the terms that we use now, from offshoring to friendshoring. And then Dr. Goel did something which was really important, to give you a real life understanding of how Indian policy has been actually dealing with all the shocks that have been thrown to it. And I loved the simplification through the BCCR, which talked about the balance, the coordination, the counter-cyclical actions, and the reforms. So, the fact is we've got a good perspective from people who have really informed an understanding of this economy as it unfolds every day. And it is really a challenging time, not necessarily just in the economy, but in interpreting how the economy unfolds. So there are great opportunities for all of us if we interpret faster or quicker how the economy unfolds. The world right now is in that situation, and all of us are happy that we are sitting in India right now rather than in some other part of the world. So with that, I'll bring this to a close. Thank you, Dr. Goel, for joining. Thank you, Louis, for coming, and thank you, Tom, for your perspectives. Thank you. And the reason that CII loves me as a moderator is I begin and end in time. They are all saying a silent prayer right now.
Thank you, Dr. Sinha. May I now request Ms. Amita Sarkar, Deputy Director General CII, to give away ODOP gifts to our esteemed panelists.
For Professor Goel, we'll have it sent to you.
Yeah. May I request for a group photograph, please? Thank you, ladies and gentlemen. May I request you all to join in Darbar Hall with an interaction with Dr. Mansukh Mandavia, Health Minister of India.
Our today is about delivering excellence across business sectors